Joining us now to talk markets, inflation, and more, Michael Landsberg. Landsberg, Bennett, Private Wealth Management, Chief Investment Officer. You'd be hesitant to go all into anything right at this point because of what we were just talking about.
Absolutely. I mean, I think it's a scenario that, as you said, we're going to find out some more information tomorrow, but Friday it'll be different. And I think we've got to look down the road and say, what do I want to invest? If I'm a CEO of a company, do I want to deploy any capital in the U.S. for manufacturing? I don't necessarily think so. I look the same way as an investor. I don't necessarily want to deploy capital right now to areas that are very tariff affected. Why would I want to do that? So we've got to look, and we've been looking at other areas that don't necessarily have a lot of effects via tariffs, things that we have to have. And I think the pain continues in some of those names because people are uncertain.
So you don't think that what we've seen, the sell-off to this point, down 10%, or 10.4% for the NASDAQ over the last month, down 4.5% for the S&P, you don't think that reflects the potential pain from tariffs?
I don't, because what I think the economy, the tariffs are obviously the thing that we're going to talk about, but the GDP is slowing. You start looking at some things, I think earnings are going to be down. So I think you start to look at what's going to happen going forward.
What do you mean earnings are going to be down?
Decelerating from where they were.
So the rate of growth
Absolutely
is going to be slower. Earnings aren't going to be lower.
Aren't still lower, okay, but decelerating from where they were. NASDAQ probably is going to be...
We need a recession to get earnings down.
100%. I mean, that's good. I mean, I don't think we're going to get a recession. I think we're going to get slower GDP. But I think the area is why try to pick a falling knife? NASDAQ has had such a good run for 2 years. A lot of these names that are beaten up the most have been up the most for 2 years. So it's some logic there that, hey, some of these stocks have been up 100, 200%.
If we go back and just in the recent history and talk about what we were talking about in 2023 and 2022, we were talking about testing the S&P lows of 3,200 and 3,300. Yeah. Most analysts thought we were going to get down to 32 or 3,300. And look where we are. So we need to realize what do we get? Where are we? We're at 5,600 right now. I mean, we could easily test 5,000, I would think, or 4,500 even. That's
10%. That's not much. Considering how much we've risen, I don't think that's, and especially in some
even
of the
without tariffs, you could almost
100%. The tariffs, I think, are one of these things that we don't have an answer to, and I think it's been a good reason for people to sell. As opposed to saying, we've made a lot of money, now it's like, hey, there's some unknowns, there's some uncertainties, let's take some money off the table. Where do I go? I go to the names that have done the best. And some of these names have doubled or, in some cases, tripled in the last couple of years. That's the places that the most pain has been tech and discretionary, where healthcare and staples in particular, they've done so poorly that, that's where the money's flowing right now. It's a little bit of a rebalance trade.
I mean, it's probably worth pointing out that from the all-time high, you're still down 8.7% for the S&P 500 and more than 14% for the NASDAQ. So
that's not even really correct. I mean, the S&P is not really even correction mode yet.
Yeah.
I mean, it's so...
We were there briefly.
Yeah, for a short time.
Yeah, what are you doing then?
We're continuing to look. I kind of look where I don't have to fight kind of the market. So we like Europe now. Europe was in a lousy place for a couple of years. We're seeing actually a lot of the earnings from the S&P.
You think it's going to get better, given that we're going to have some kind of massive fight between all of these countries?
I don't know if it's better. I think it's a better option than just having all your money in the U.S. You've had a good run not having anything out of the U.S. the last couple of years. I think that's changed now, where you want to start allocating some more. I think the places that you have to spend money, we like utilities. Insurance is a necessity. It's like an evil. Right. You have insurance. I think those are areas that are going to continue to do well, whereas your discretionary purchases you don't have to make. So I think the issue for a lot of consumers and businesses is, if I don't need that, do I want to buy it in this environment? I think the answer is going to be no. So we want to stick with the stuff that we know you have to buy. Right. Utilities would be one, insurance. Staples would be another. And then the stuff that I can put off, I'm going to put off until I get some clarity around this back and forth with tariffs.
And you're not convinced the Fed is up to the task of managing it perfectly through these things?
They really haven't been. I mean, I look kind of at what's gone on. Transitory was a big phrase, and we got to record inflation. Even last September, they said, hey, inflation's going to continue to go lower. It went higher. My concern is we don't use PCE, we use CPI. And a good example of that would have been what happened last September. PCE was flat from September till January. CPI went up 22%. The CRB index went up 20%. So for the investor, I don't want to look at a metric that has got no value to me. Yeah. My concern is inflation's really affecting the average person, and PCE kind of mutes that with replacements and substitutes and things like that.